Jamie Dimon, the CEO of JP Morgan, is raising the alarm. There could be a monkey in the wrench of the global economy. Stagflation could be coming. I want to discuss that with you as well. Of course, this is all happening on the backdrop of rising recession fears as more and more macro insanity continues. Things keep breaking or nearing breaking points, and it's getting people kind of freaked out. So we're going to talk about that in this video. Before we do that, make sure to smash that thumbs up button if you love this kind of content, and subscribe to the channel if you're new around here so you get more of these videos in the future. Let's get it. So, Jamie frickin' Dimon. And I know, Jamie Dimon, right? That guy, come on. And JP Morgan. I mean, these guys. Not forgot about the cocaine boat, JP Morgan. Anyway, Jamie Dimon said, I ask people in business, are you prepared for something like 7% interest rates? The worst case is 7% with stagflation. If they are going to have lower volumes and higher rates, there will be stress in the system. We urge our clients to be prepared for that kind of stress. Now, look, I don't think that's necessarily a wrong statement. I do, of course, always think with Jamie Dimon, can't believe everything he says. It could be psyops. JP Morgan, are the master manipulators of markets. They are the masters of psyops. However, it's not just Jamie Dimon who has been talking about the possibility of stagflation. We've had other great investors also warning about the risks of stagflation, where we have a stagnant economy, not necessarily a recession, actually, although we're going to talk more about the recession in a minute, but not necessarily recession, just a very stagnant economy, not a lot of confidence in the economy, not a lot of consumer spending, quarter-to-quarter growth, anemic, 0.5 percentage point, stuff like this. Not great, but not horrific, with high inflation. That is what we call stagflation. So stagflation is an economic cycle characterized by slow growth and high unemployment rates. Remember, employment has gone up recently to 3.8% in the USA. Economic policymakers find this combination particularly difficult to deal with, as attempting to correct one of the factors can exacerbate another. Once thought by economists to be impossible, not anymore. Stagflation has occurred repeatedly in the developed world since the 1970s oil crisis. In mid-2022, many were saying the United States had not entered a period of stagflation, but might soon experience one. Year later, people are still warning about a potential for a stagflation event to happen, if only even for a short period. In June 2022, Forbes magazine argued that a period of stagflation was likely because economic policymakers would tackle unemployment first, leaving inflation to be dealt with later. Now, look, inflation's down. A year later, we can see inflation has come down. Obviously, unemployment's only up a little bit, so not a massive crisis. But what kind of causes these sort of things? One is things like oil price shocks. And guess what? We are currently experiencing a shock in the oil prices. Oil prices are surging up currently. Right? The Saudis and the Russians are cutting production. Demand remains high. Prices are going up. You can blame poor economic policies. I mean, everybody, do we forget that we printed trillions of dollars in 2020 and 2021? Something like 40% of all USD in existence or something like that was printed in a year's time span. Crazy, crazy stuff. You might just blame the simple reality of modern monetary theory, the loss of the gold standard, the fact that your currency is backed by a trust me bro from your government. And that's it. So these are all very, very real concerns. And again, it's a real concern, but it's a real concern being brought up by somebody I fundamentally distrust. Jamie Dimon. Don't believe his lies. Look, there's a lot of factors here to unpack, and stagflation is just the latest cherry on top of worry that we have in markets in the macroeconomic scene. But before we get into those other factors, I did want to make a quick moment to mention the Wealth Mastery Investor Report. Look, if you are investing in the cryptocurrency space, the Web3 space, you got to get signed up to this newsletter. It's the best damn newsletter in the frickin' business. Every single week, we send it to you 3 times. Every issue, jam-packed full of value. We cover the news. We cover the latest alpha, whether it be altcoin alpha, DeFi alpha, what's going on in technical analysis, latest airdrops, and much, much more. Join our 75,000 weekly readers by using the link in the description. We can sign up for free. Check it out. Now, what are some other factors that are potentially contributing to a recessionary environment forming up? And remember, we covered in a video recently that usually recessions follow anywhere from 6 to 17 months on average after the Federal Reserve's last interest rate hike. How long it will take this time? Uncertain. Recessions are normal parts of the economic cycle. They will come again. Only question is when it comes. I just wish it would come sooner than later so we could stop talking about the damn thing, get it over, pull off the Band-Aid, let's just deal with it and be done with it. Not quite there yet. Joe Consorti pointing out the M2 money supply in the USA fell 3.7% in August. Yikes. This is the longest, deepest streak of money supply contraction in 90 years. Wowzers. Now, one thing you want for markets to go up, for risk assets to go up, more money in the system. You can see, of course, the big spike there that came from the stimulus packages around the Mexican beer pandemic. That sent markets raging. Tech stocks raged, crypto raged, everything raged. Now everything's going down as the M2 money supply is falling. So that's a very important metric to keep an eye on, and it's still going down. And it's not just the global money supply. It's regular people, too, are getting smashed right now. Americans outside of the wealthiest 20%, that is, have run out of money. They don't have any extra savings, and now they have less cash on hand than they did back when the pandemic actually began. That's according to the latest Fed study of household finances. Regular people are feeling the pinch, and if you want markets to go up, you need to have lots of people with money coming in and buying stuff. If your average person, the retail herd, doesn't have money to buy stuff, markets aren't going to do anything super exciting. And markets in a stagflation event are going to be a bit dicey anyway because the average consumer doesn't have a lot of money. Everybody's worried about unemployment, losing their job. They don't have much savings. They have high credit card debt. Companies are refinancing at super high interest rates. People aren't buying houses. The wealth effect goes down. All these kind of things start to pile on top of each other, where we have all of these short-term, remember, 5-10 years from now, we're going to be fine. Short-term, next few months, next half year to a year, we have all these things rising. The bond yields are rising, which is causing a lot of chaos in one of the world's biggest markets. The bond market's one of the biggest markets in the world. A very boring market, but it's freaking huge. Inflation still uncomfortably high. Gas prices, as we mentioned, going up. Consumers continuing to get squeezed in a very, very serious way. Credit card debt absolutely going nuts right now. And Americans are defaulting at the highest levels since the financial crisis right now on their credit cards and on their auto loans. Not a great statistic and not a great time to be compared to. Whatever you want to compare your current economic conditions to, you don't want to compare it to the global financial crisis of 2008. There it is. One metric anyway, and there's others, obviously, that we've covered recently in videos, but this is another one that's definitely worth paying attention to because, again, if the average consumer, they're defaulting on their credit cards, defaulting on their auto loans, they are screwed. And if you don't have regular people coming into the markets, who's going to buy the monkey pictures? No one. The S&P 500, as we discussed recently as well, driven basically by the top 7 tech stocks on the back of the AI hype. Chinese property market continuing to be in trouble. U.S. debt hits a record high over $33 trillion. U.S. government could be shutting down in a few days. All these fun sort of things are happening. Here's another one. The Cleaver Real Estate Survey reports that 39% of Americans have skipped meals to afford their housing payments, with the figure rising to 44% among millennials. Dudes, people are having trouble feeding themselves right now. Think about that. Think about that. If you are living in a situation right now where you have the economic security to be able to feed yourself, be able to feed your children, you're lucky. I mean, globally, you've always been lucky if you're in that situation. We all have a little bit of gratitude if we live in a first world country where we don't have to worry about our children dying from lack of sanitation or malnutrition. And those numbers have been falling globally for a long time. But here we are when economic crises like the one we're experiencing right now come, we see a situation where people are pinched and people are having to make the tough choices. Do I keep my house or do I eat this week? And again, no one's buying monkey pictures in that scenario. Magic internet money remains a very far off priority for most people in that scenario. Tech stocks remain a far off priority for most people in that scenario. It's very, very problematic. And I want to share this one with you here as well. If you are betting on a soft landing, aka not a recession happening, then energy leadership is especially problematic. Now, Warren here is pointing out that energy has been leading. We've seen, of course, oil prices going up, which creates more inflationary problems and all these sort of things. That creates problems for the soft landing narrative, because when energy prices are soaring, it creates all kinds of consumer pressures for the end user of products, who has to pay more to buy food and pay more to go to work and all these sorts of things. Problematic right across the board. Look, a recession will come. The only question is, when is the recession going to come and how bad is it going to be? And that's a question that we don't have an answer to yet. The smartest minds in the world don't have an answer to yet. Whether we talk about the CEO of JP Morgan or Ray Dalio or Jerome Powell at the Fed, nobody really knows what's going to break, when things are going to happen. Well, we all have our guesses and we have our speculations regarding that, but it'll come. It may not come as soon as you think, though. If we look at historically how these things have played out, it could be a while yet, which means that until it does come, all sorts of uncertain things could happen in the market. We could have a massive market rally between now and when a recession actually happens. It's happened in the past. In fact, in 2006, we had very similar financial conditions in a lot of ways. Markets rallied. The S&P 500 went up another 30% before the big crash. And I see a lot of clever people, let's say, talking about that scenario where we have one final blow-off top for the market. Rates are going to pause higher. We still have one more interest rate hike to come. Rates pause higher. Then we see a scenario where markets breathe a little bit and markets go up before the real big crash comes in. Not saying that's necessarily how it's going to play out, but it's a narrative that I've seen being shared around a little bit. But let me know, what do you think? When are we going to get to this damn recession finally? Or are we going to avoid a recession? We'll really have a soft landing, but a soft landing with stagflation. What's your prognosis for how the economy is going to move forward? Very curious to hear your thoughts in the comment section down below, and I'll see you next time.